Alibaba and all the Chinese internet companies have fallen off a cliff recently. Let's take a look as to why that's happening and how we should react to this recent sell-off. Welcome back to the channel. It's me, Adam. You're watching Steady Invest. And investors have been getting out of the way literally, as the stock has fallen 15% from all-time highs just a few weeks ago. Alibaba stock, which is technically an American depository receipt, trades on the New York Stock Exchange under the ticker symbol BABA. And they are an absolute beast of a company. They're pretty much the Chinese Amazon. They get the bulk of their revenue from their e-commerce website. They have their own cloud computing services, as well as they have a huge stake in fintech technology, because of their 33% stake in Ant Group, which we're also going to be talking about in this video. Before we do, smash that like button. If you're new to the channel, hit that subscribe button, and let's get started. Alright, let's take a look at the chart first. So we IPO'd back in 2014. It was actually the biggest IPO ever at the time, as it was valued at $25 billion. And it traded sideways for a few years until 2017, and then it went upwards. Traded sideways until the end of 2019, went up, market crash happened, went down. And then from the crash, we hit all-time highs a few weeks ago, and then we've gone down ever since, and now we're up 40% since the crash. Looking at the 1 month chart, we hit all-time highs on October 27th, and then ever since then, we're down 15%. And people are losing their minds right now. But we have to take into consideration, year-to-date, we're still up 23%. It's a $717 billion market cap, and it's pretty much the size of half of Canada's publicly traded companies. When you look at the full world view, you can see Alibaba is one of the world's biggest companies. So there's two main reasons why investor sentiment is so low right now. The first one is Chinese regulators consider new antitrust rules for online platforms. The rules include a variety of anti-monopoly actions like offering different prices for the same product to different groups of consumers. That's a little bit messed up. I don't blame the government for cracking down on that. The new rules will attempt to stop companies from sharing sensitive consumer data, teaming up to squeeze out smaller rivals, and selling at a loss to eliminate competitors. They would also clamp down on platforms, forcing businesses into exclusive arrangements, something which Alibaba has been accused by merchants and competitors. And we've been seeing this with big tech in the US as well. The European Union has announced antitrust charges against Amazon, which it accuses of abusing its market power in Germany and France. Meanwhile, US authorities are taking action against Google's dominance as an internet search engine. Not to mention the antitrust hearing back in the summer with Amazon, Apple, Facebook, and Google, which was a debacle on its own. So Alibaba and the Chinese internet companies definitely aren't alone. Not to mention Jack Ma, the founder of Alibaba, is taking shots at the Chinese government and their banks. Ma said, "Systemic risk is not the issue in China. Rather, China's biggest risk is that it lacks a financial ecosystem. Chinese banks are like pawn shops, where collateral and guarantees are the hard currencies. As a result, some decide to go so big they are not allowed to fail. As the Chinese like to say, if you borrow 100,000 yuan from the bank, you are a bit scared. If you borrow 1,000,000 yuan, both you and the bank are a little nervous. But if you take a 1 billion yuan loan, you are not scared at all, the bank is." And I like people who are outspoken, but the Chinese government and their banking system are not the people you want to go after. And this is why you don't mess with them. The second reason investors are so bearish right now is because China halted Ant Group's blockbuster IPO. And it was supposed to be valued at $310 billion, the world's biggest IPO to date. And for those that don't know, Ant Group, formerly known as Ant Financial, are an affiliate company of Alibaba. The group owns China's largest digital payment platform, Alipay, which serves over 1 billion users and 80 million merchants, with total payment volume transaction reaching 118 trillion in June 2020. And Alibaba owns a 33% stake in this company. As if Alibaba wasn't huge already. All bad news for Alibaba, driving the price down. As well, the valuation could be slashed by over $150 billion after the suspension. Now, is that priced into the 270 we see right now? Maybe. It comes as Beijing announced there will be proposed regulations on microlending, a move that could force Ant Group to hold more capital and make the company look a bit more like a bank rather than a technology company. The biggest risk for Ant will be shifting from a fintech to a capital-intensive regulated bank and not losing its competitive connection with consumers. 2 days before the listing, the Shanghai Stock Exchange said it was going to be suspending the IPO and that Ant Group reported significant issues such as the changes in financial technology regulatory environment. The shock move came after Ma appeared to criticize Chinese regulators and after he and 2 other top Ant Group executives were called into a meeting with regulators 3 days before the listing. Don't mess with Chinese regulators. But it's not all bad news. Alibaba hit a record for their sales for Singles Day at $56 billion. Although it was overshadowed by a 10% stock plunge as China proposed a new regulation. Minor detail. For those that don't know, Singles Day is a Chinese unofficial holiday and shopping season that celebrates people who are not in relationships. And I found this really interesting. They chose the date November 11th because the number 1 resembles a bare stick, which is a Chinese internet slang for a single man who doesn't marry and thus can't add branches to the family tree. In other news, Cathie Wood, the head of ARK Invest, sells Tesla shares to buy the dips in Alibaba and PayPal. Now, this could also be some portfolio rebalancing since Tesla's run up so much this year, but they're also trying to take advantage of these dips as well. And this article came out on November 4th, when the stock was only down 8% at the time. The ARK FinTech Innovation ETF bought 9,443 shares of Alibaba, and the ARK Next Generation Internet ETF, ARKW, bought 29,683 shares of Alibaba as well. Taking a look at their September quarter 2020 results, which was published just a week ago, they had 30% year-over-year total revenue growth and 29% year-over-year core commerce revenue growth. Those are huge, considering how big the company already is. Their cloud computing revenue growth went up 60% year-over-year as well, and they were very profitable at $6 billion. And I really like how they broke it down in the report as well. We can see 84% of their revenue comes from their commerce, and 10% from their cloud computing as well. And to reiterate, these are huge numbers for a company that's already big. Looking at the 6-month chart, it looks like we've bounced off this 260 mark over here. However, I would have said our support's around 270, 265. So the fact that support has been broken, we could see more downside up until this support at about 245. And I'm currently a shareholder right now. You can see actually here that I bought on the way down. And you can see where I bought if you see those green triangles. So I bought around this level over here and this level over here. But I'm already pretty satisfied with my position right now. I won't be adding any more unless we get closer to that $245 mark. There's a lot of negative news surrounding Alibaba right now, but it's important to remember not much has changed fundamentally about the company. Their growth prospects are still really strong, it's just that investor sentiment right now is low because of news. But news moves stocks every single day, whether it's positively or negatively. That's just the stock market for you, especially when it comes to growth stocks. Volatility is expected. It's important to not react emotionally and to not panic, especially if you bought into the stock just a few weeks ago. You have to remind yourself why you bought it in the first place and that you believe in this company for the long term, and that short term shouldn't affect that. Being a shareholder myself, it sucks to see your gains disappear and to see your stock going down, but that's the stock market for you. But when a company changes fundamentally, that's when you should reconsider whether it deserves a spot in your portfolio or not. And in my opinion, I haven't seen anything to change my mind yet, but that's just me. And if we see any continued weakness in the share price, I might consider adding more to my position. As always, thank you very much for watching the video. Drop me a comment, let me know your thoughts. Are you buying the dip or are you cutting your position? As well, as always, smash that like button. If you're new to the channel, hit that subscribe button. And if you're in Canada and want to start trading with Wealthsimple or Questrade, use my links below. We'll both get free money. See you guys in the next video.